In this video, traders, I want to talk you through some of the common characteristics from blown up trading accounts so you can avoid them. Stay tuned. Hey traders, a very warm welcome to you. Thank you so much for joining me. All right, so in this video, I want to share with you some of the things that I have discovered whilst looking through blown up trading accounts. Where can you find blown up trading accounts, you might ask? If you go onto a lot of these copy websites, you can look at trades that are not on the traders that aren't on the leaderboard anymore. They're well down. Sometimes you can filter as well by negative returns and all this type of stuff. And you can kind of see how people behave who blow up accounts, which is the majority of people. The majority of people are going to lose. Now, blow up accounts might be a bit harsh. Not everyone blows up accounts, but this is the commonality that you see with many traders who do blow up accounts. And so when I study these and you kind of look at these, and there's also a couple of videos out there on YouTube World where people have kind of dissected some of their poor performance on some of these virtual online prop firms, have kind of looked into the poor performance and gone, oh, this is what's doing that, this is why, and they can sort of see the equity curve and showing some of the trades. And without fail, guys, these are exhibiting all of them. Honestly, I've not seen one yet that doesn't exhibit this. I'm sure, now, does that say it doesn't exist? Of course not, but that's good enough for me. And I've looked at dozens of these and gone, hey, look, they're all doing the same damn thing, man. They're just doing the same thing. If they didn't do these things, who knows? Would they be profitable? I don't know if they're profitable, but they wouldn't blow up. That's for sure. So not doing these things means you won't blow up. Doesn't mean you're going to make money, no. But if you can at least eliminate the chance of blow up, you've got a damn good chance of at least sticking out the game. Because this is the point, right? And digressing very slightly, we'll get back on topic in a moment. The name of the game in trading is to stay in business for as long as possible until you get the experience to push you through. And you need capital, you need mental capital, you need this to be able to stay in the game for years so that when you're coming out the other side, you've got the experience, you've got everything, you go, I made it, things are starting to work now. Does that mean you're going to just hockey stick up? Sometimes people do, but it does mean you're going to be able to have the longevity and the experience to put to good use, and you have got the assets, mental capital and financial capital to work with. So what is the big thing that these guys do? Adding to losers, that's a huge one, a huge one. All of the traders that I look at, they all add to losers. And listen, maybe the sample size isn't big enough. I'm just literally showing you what I see when I look at this. And I can almost guarantee if you give me another 10, another 50, 80% of them will be adding to losers, if not more. Maybe not one of them might get caught out by something nasty, but you get the point. It's this constant desire from traders to hope. And it's hope, right? You go, and ironically, I did a video very, very recently. I talked about adding to losers, but that was a very different, go and watch it because it talks about how under unusual circumstances you might have this scenario. What I mean adding to losers here is people just do it because the price is lower. The price is higher, I'm going short. The price is lower, I'm going long. And it's that perspective rather than being structured. It's hope. It won't take, if I add to this, then it will less to come back to break even. And they do this constantly. And then there's the big losers, small winners. So we have this constant thing of like, there's a winner, grab it. There's a winner, grab it. And this also sometimes results in this on the equity curve. Like jing, 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 doing okay, doing okay, doing okay, doing okay, doing okay. And the clock is ticking, here comes the big loser, boof, slam. The big loser comes out and it wipes out all of the winners and more and puts them in significant drawdown. And so you can't operate like this. You can't operate from a perspective of every winner's got to be small. You can operate from small winners, small losers. You can operate from big winners, big losers, but you cannot operate from big losers, small winners. You want to get to a position where you're big winners, small losers, but this is just the scenario just doesn't work. And so you have to be able to run your trades, and more importantly, you have to be able to cut the losers. You have to be able to take that medicine and go, this trade is wrong. This trade could bounce the moment I close it, but I must commit to pulling the plug on this right this second. Doof. And doing that and getting just so good. And I did a podcast where Gregor talked about his first profitable year day trading the DAX. And one of the things that he said that was so true was, well, not true, but one of the things that he said that worked well for him was he just went through drills of cutting losers, cutting losers, cutting losers, cutting losers. So he got good at being able to just cut losers. He recognized that this was going to kill his growth. He wasn't going to get anywhere until he could cut those losers. And I know it's so simple. I know you hear it all the time. You heard it from day one of whatever trading site you've been on or thing, cut losers, cut losers. But it is so important. The data shows it. You know it. You've seen it in your own trading. You absolutely must get good at cutting losers, and you must try to run the winners. One step at a time, cut the losers, small winners, fine. It's going to flatline you. It's not going to result in this. But the big theme is they would just let those losers get out of hand. And it was a result of adding as well, because you're in the biggest size on your worst trades just by the nature of doing that. And you're in the smallest size on your best trades, especially if you're scaling out and you're inversing things. So just think about that. Don't add to losers. Look out for the big losers. And then you'd have the inability to recover from drawdown. And that was a big thing, right? Because they'd have this, and the mental anguish of saying, let's say it was 3 months worth of gains or 3 weeks worth of gains, and then undone in 1 day, 2 days, 3 days, 4 days by big, massive losers that weren't successfully risk managed, was just devastating to these people, and they never really recovered. Or if they did, it would just screw their heads. And they would, if we moved to this, they would trade the equity curve. So they would kind of recover. They'd get back to break even and go, I'm a break even. And then they'd flip the way they trade. They did trade differently because they'd be trading their equity curve. They'd get nervous, and all of a sudden they wouldn't make any progress, and bang, you'd be back to square one. And so you never ever can get any growth or any success and longevity and traction when you are constantly hitting, doing well, bang, doing well, you claw yourself back, and then bang. It's just, not only is it mentally debilitating, but financially, and eventually that loser will just be so great that you just go on tilt, and kind of this kind of scenario where you had that loser, you fed up, you finally got yourself back to break even. There's your zero mark. I've done it, back to break even. Something happens, big loser, you add to it, bang, and then you just give up and you blow up. So, inability to recover from drawdown, and really it's the inability to recover from drawdown is just from a basic structural problem with the big losers, small winners, and adding. And obviously that compounds the big losers. But if that's just adjusted, if you can get to the point where that's just adjusted, then you're going to be in a far, far better position. If you use a coin toss, right, 10 ticks profit, 10 ticks stop, 100 ticks profit, 100 ticks stop, bang, and traded that, it would be a far better equity curve than this. Now, is that an edge? No, but it's the point. And then it's giving up on rules quickly. So very often the mental anguish of having these big drawdowns, big kind of hammerings to the account, just ends up meaning that they give up on rules quickly. They take too much position size. They don't take a stop when it comes. They just end up swinging around, over trading, wanting to get back, trading the equity curve, desperately wanting to get back to zero, desperately wanting to recover, hope, desperation. Market smells it. Market says, come here, sir, come here, come here. There's a lovely little place I want you to stand. It's a trapdoor. Thank you for all your money. Thank you for playing. Please come again. And that's, I know I'm joking about it. It's ultimately kind of what happens. So adding to losers, don't add to your losers. Big losers, small winners, flip it if you can, or at least get rid of the big losers. Inability to recover, so stick to your rules. You stick to the rules. If you are in drawdown, like small losers, small losers, small losers, small losers, small losers, that's easier to manage than these big, brutal drawdowns. And giving up on rules, never give up on your risk rules. Always stick to your risk rules. By all means, adjust and adapt at various points in time, but never give up on them. And then trading the equity curve. We don't trade the P&L, we don't trade the equity curve. That is number one thing that you see. And how do you know this? Well, how do you know this? Because you can see how their performance just tops out when it gets back to zero, or when it gets back to previous highs. So they're desperately looking at the equity curve going, oh, I'm back at highs now, I must do this, I must do this. And especially for guys who are trading the online prop challenges, when they're getting really close to just passing it, and they're a couple of $100 away, and they mess it all up with a silly trade. Anything, you blatantly were looking at that thinking, I just need $200 more and I'm through. And it's the same thing. It changes the way you think about things. Eliminate that, and you'll have much, much better performance. All right, guys, common characteristics from blown up trading accounts. If you've blown up a trading account, I'd like you to be honest and share and say what caused you to blow it up. Was it just a complete disregard for rules? Was it a Hail Mary trade that went wrong? Was it a drip lower that you just got fed up with and swung for the fences and it didn't work out? What was it? Was there some type of thing or common thing that you did maybe it was years ago in your trading career, maybe it's recently, that just really contributed to that blow up of an account, that you know actually that if you did it again, if you eliminate those things, you'd be in a much better position. Take care, see you next one, guys. Bye-bye.